Welcome back to the Daily Crypto Deep Dive. Today, we are going to discuss Bitcoin's current price range because Bitcoin isn't crashing. It isn't breaking out either. And the longer it sits in this tight range, the more uncomfortable it becomes for people who expect markets to always be doing something dramatic. But this phase, this slow, sideways grind in the low $90,000 range, is not a sign that Bitcoin has lost momentum. It's a sign that the market is being reshaped by a very different type of participant than we've seen in previous cycles. Today's deep dive is about why Bitcoin isn't moving, why that's frustrating for retail traders, and why institutions quietly prefer it this way. Because when price goes quiet at high levels, history tells us something important is usually happening underneath. Let's start with what's visible. Bitcoin has been trading between roughly $91,000 and $94,000 for weeks now. Every push, higher stalls. Every dip lower gets absorbed. There's no cascade of liquidations, no blow-off top behavior, and no panic selling. Volatility has collapsed. Daily candles are tight. Weekly ranges are compressed. To many traders, this feels unnatural. After a move like Bitcoin had last year, people expect either continuation or collapse. What they're seeing instead is stagnation, and stagnation often gets misread as weakness. But when you step back and look at Bitcoin's historical cycles, this behavior is anything but unusual. After the 2016 halving, Bitcoin spent more than half a year going sideways before the real 2017 bull market began. After the 2020 halving, Bitcoin ranged for months before the breakout that carried it to new highs. Sideways price action is how Bitcoin digests gains. It's how supply changes hands from short-term holders to long-term ones. What's different this time is not the consolidation itself, it's who is doing the buying during it. In previous cycles, consolidation phases were driven largely by retail fatigue and miner selling. This cycle has added a completely new structural layer. Spot Bitcoin ETFs, institutional allocators, corporate treasuries, and asset managers who operate on entirely different time horizons. As James Seifert, ETF analyst at Bloomberg, has repeatedly pointed out, ETF buyers are not momentum traders. They are allocation-driven. They scale in over time, rebalance periodically, and care far more about volatility and liquidity than short-term price direction. That matters because since the ETF approvals, Bitcoin has effectively been absorbed into traditional portfolio construction models. And those models don't chase green candles. They buy stability. If you look at ETF flow data over the past few months, it tells a very specific story. Late last year, ETFs experienced meaningful outflows as macro conditions tightened and risk appetite pulled back. That selling pressure is now largely behind us. Flows have stabilized, and in recent sessions they've quietly turned positive again. Not explosive, not headline-grabbing, but consistent. According to data cited by Glassnode, ETF demand has shifted from being a headwind to a neutral to supportive force. And that shift matters more than daily net flow numbers. It tells us that structural demand is no longer exiting the market, and that creates a floor. On-chain data reinforces this interpretation. One of the most striking trends over the past several weeks has been the collapse in realized profit-taking. At the height of last year's rally, over $1 billion per day was being realized in profits. Today, that figure is a fraction of that. In other words, people are no longer rushing to sell into strength. Glassnode analysts describe this as sell-side exhaustion. When price rises but profit-taking remains muted, it suggests that new buyers are absorbing supply faster than sellers are willing to part with it. At the same time, accumulation metrics are flashing strongly. The accumulation trend score, which measures whether wallets across different size cohorts are accumulating or distributing, has remained near its maximum reading. Large holders, wallets holding hundreds or thousands of Bitcoin, are net accumulators. According to Glassnode, these large entities are absorbing Bitcoin at a rate that exceeds new issuance from miners. That's an extraordinary shift in market structure. In previous cycles, miners were a constant source of sell pressure. Today, miner issuance is a rounding error compared to institutional demand. CryptoQuant's Ki Young Ju has highlighted this repeatedly, noting that while short-term holders have been shaken out during recent pullbacks, long-term holders have quietly returned to accumulation mode. His view is blunt. This is not distribution. It's consolidation. And that distinction is critical. If whales were distributing aggressively, we would see it in exchange inflows. We would see spikes in realized profits. We would see volatility expand. We're seeing none of that. Instead, exchange balances continue to trend lower. Coins are moving off platforms into cold storage. That's not speculative behavior. That's positioning. Now let's talk about volatility, because this is one of the most underappreciated signals in the market right now. Bitcoin's realized volatility has compressed to near-cycle lows. Options markets are pricing relatively small moves in either direction. Implied volatility across 1 to 3 month tenors has fallen sharply. For retail traders, low volatility feels like boredom. For institutions, it's an opportunity. As Deribit analysts have noted, low volatility environments allow large players to structure positions, issue products, and manage exposure efficiently. It's much easier to build size when price isn't whipping around. Even more telling is what's happening inside the options market. For the first time in months, demand for upside protection has overtaken demand for downside protection. In practical terms, institutions are paying more to hedge against Bitcoin moving higher than moving lower. That doesn't mean a breakout is imminent, but it does tell us where risk is being perceived. When options skew flips positive like this, it often creates mechanical effects. Dealers who sell call options hedge by buying spot Bitcoin as price rises, which can amplify upside moves once they begin. This dynamic has played out repeatedly in past cycles. At the same time, futures leverage has been largely flushed out. Funding rates are neutral. Open interest is no longer stretched. The market is clean. As one Glassnode report put it, the market has transitioned from defensive deleveraging to selective re-risking. That's exactly what a base building phase looks like. So why hasn't Bitcoin already broken out? Because institutions are disciplined. Bitcoin is no longer a fringe asset. It trades alongside equities, bonds, and commodities. When macro conditions are uncertain, when rate cut expectations fluctuate, when liquidity conditions tighten, institutions allocate cautiously. They don't chase momentum. They wait for confirmation. This is why Bitcoin's consolidation has coincided with record equity market highs. Capital hasn't left risk, it's just been selective. And Bitcoin, now viewed as a serious asset, is being treated accordingly. Matt Hugin, CIO at Bitwise, has argued that this cycle will feel slower and more frustrating, precisely because institutional participation smooths volatility. He's also pointed out that when breakouts do happen in institutionally dominated markets, they tend to be sharper, because positioning has already been built. That's the paradox of this phase. It feels slow, but it may be laying the groundwork for a faster move later. It's also important to address a persistent narrative, that Bitcoin should be higher by now, that ETF inflows aren't working, that something is broken. This mindset misunderstands how markets function at scale. ETF demand doesn't push price higher every day. It changes who owns the asset. It transfers supply from weak hands to strong hands. And once that transfer is complete, price tends to move, not before. In previous cycles, breakouts happened when supply was exhausted and demand had nowhere to go but up. The current data suggests we are moving in that direction, slowly. So what actually breaks this range? Historically, Bitcoin leaves consolidation phases for one of three reasons. Either demand accelerates suddenly, supply dries up completely, or macro conditions shift decisively. Right now, supply is already tightening. Demand is steady, but controlled. That leaves macro and sentiment as potential catalysts. If liquidity improves, if rate cut expectations firm up, or if risk appetite returns more broadly, Bitcoin is well positioned to move. But even without a macro trigger, volatility compression itself can become the catalyst. Markets do not remain quiet indefinitely. The key point is this: sideways does not mean weak. Sideways at elevated levels, with accumulation underneath, usually means pressure is building. Bitcoin is not being ignored. It's being absorbed. It's being normalized. And it's being positioned as a long-term asset by capital that does not care about daily candles. That doesn't make for exciting headlines, but it does make for powerful moves when balance finally breaks. If the market feels boring right now, It's probably doing exactly what it's supposed to be doing. And when it stops being boring, it rarely gives much warning. Drop your thoughts in the comments, smash like, follow, and as always, we will see you at the top.